Don't you just love that feeling of opening up your bank account on a Friday afternoon and seeing some money deposited there? Whether it was your paycheck, maybe some interest, or even some kind of reimbursement that you weren't expecting to receive. It's such a great feeling, and what if I told you there was a way to do this through an investment strategy as well? Hey guys, just Vish here. I hope you guys enjoyed today's video where I'm going to be taking a deeper look at the differences between dividend and growth investing. And if you learned something, please consider hitting that subscribe button, as I'll be doing a couple more of these videos and I hope we can all learn together. Stay tuned. When we look at the two different strategies, a dividend strategy versus a growth strategy, a dividend one is essentially when a company declares its earnings, shares some of its profits with its shareholders in the form of a dividend payment. Now, these can occur monthly, quarterly, semi-annually, it really depends, but this is a way for an investor to continuously reap those rewards. On the other hand, when we look at a growth investment strategy, this is essentially when the companies declare their earnings and then reinvest those earnings back into the company. This is where they're looking at a more longer term approach to essentially cash out on all of that, and an investor that follows this approach would essentially look to maximize their benefits upon sale. So they aren't necessarily receiving any dividends along the way, but they're more focused on making a higher return upon sale. When looking at the advantages behind a dividend strategy, the amount of time that's needed to reap the rewards is far shorter. Also, you're able to have a consistent flow of cash as companies declare their earnings, declare their dividends, and pay out their dividends. You can rely on a consistent flow of income over time. When looking at the upside behind following a growth strategy, since cash inflow isn't a biggest focus, you're able to have that money compounded over a longer period of time since the company is reinvesting it. And for the company, because they don't follow a dividend strategy, you're able to reap the rewards at a later date since all of that money has been reinvested and the upside is that much greater. When looking at the disadvantages behind a dividend strategy, it's that all of the money that's paid back to investors in the form of dividend payments comes at the cost of not being reinvested back into the organization. And because that didn't occur, the upside is a little bit low in comparison to a growth strategy. Also, all of that money could have compounded over time, and when it came time to sell your interest, it could have been worth a lot more had you have not followed a dividend strategy. When looking at a growth strategy, some of the disadvantages include the time frame. So you need to hold out for the long run if you essentially want to cash out. And the second major disadvantage is that you don't have a consistent flow of cash over that long period of time. If you're someone that likes holding on to your stocks for 10, 20, or even 30 years, all of the upside that happens during that time period is all on paper. You only get to capitalize on your income upon sale. So that's where a bigger disadvantage lies. Now that you know the major differences between a dividend and growth strategy, it's essentially up to you to decide what sort of time frame do you want to follow, how much risk can you bear, and what your goals are in terms of your investment decisions. For me personally, I like to try a bit of both so that I can diversify my risk and have my hand at receiving those dividend payments. I hope you guys enjoyed today's video, and if you do, don't forget to drop a like down below and subscribe if you already haven't, as I'll be making a couple more of these videos. But until then, I'll see you guys next time.